Okay, it is 9 o'clock. Good morning. My name is John Von Paris, and I'm the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. For the record, due to a scheduling conflict, Member Jeffrey Rosen will not be joining us this morning. This time we will begin with agenda item number 1. And that would be the April 12th, 2022 open meeting minutes. Is there a motion to approve the minutes as presented?
So moved, Member Carroll.
Thank you, Member Carroll. Is there a second?
Member
Thank you.
Ardinger, I'll second.
Thank you, Member Ardinger and Member Carroll. Any further discussion? All those in favor?
Aye.
Motion carried. Minutes are approved. We'll move on to agenda item number 2 and the open text content server maintenance, and David Goldsboro will present. Good morning, David.
Good morning, Member Von Paris. Nice to see you. Good morning, Member Ardinger and Member Carroll. Hope everybody's doing well. For the record, my name is David Goldsboro. I'm CIO for MDTA, Department of or Division of Information Technology. The purpose of this memo is to present the contract J01B 26000015, which is our open text content server maintenance. The contract allows for provision for 3 years of our open text content server maintenance contract and support for the MDTA Division of Information Technology. It is used to maintain, store, and allow quick access to various documents, as well as fluent workflow management. The MDTA leverages open text content server for management of our documents to include our procurement log processing and approval, our financial file cabinet for storage of financial documents, and that would be electronic storage. Also for human resources, we scan documents there and store them digitally, and it also allows for sorting of those documents. We have several upcoming divisions, including the police, civil rights, and fair practices. They also intend on using this technology to scan in their documents and sort and all the other applications that the open text suite provides. The continued software maintenance and support will allow MDTA to maintain our current licenses, continued use of the software, as well as access to technical support as we need. The contract was procured as a small business reserve purchase order request for proposal under functional area 3 of the Department of Information Technology's commercial off-the-shelf contract. That is contract number 060B2490021. That is a state do it contract. There were 5 small business reserve master contractors who were authorized to supply open text maintenance and support. They were requested to submit bids. 2 of those vendors responded. One of the 2 was the lowest financial proposal, and that was provided by NNet Services, LLC, with a total cost of $651,674.49. Bid justification is not needed. The contract exceeds the delegated procurement authority of the Maryland Transportation Authority, and therefore will be presented to the Board of Public Works on June 8th of 2022. And with that, Member Von Paris, be happy to take any questions on this item.
Okay, thank you, David.
Sure.
Are there any Any questions from any of the members?
Member Artinger, is this something new or is this just an ongoing and we're just re-upping?
Good question, Member Ardinger. This is ongoing. We've been using OpenText for, I would say, a good 7 or 8 years now. It's been our document management system, and we've expanded the use of the platform.
Good question. I agree. Any other questions, Member Carroll?
No.
Okay, thank you. Is there a motion to approve the item as presented by David?
This is Member Artinger, also move.
Second, Member Carroll.
We have a motion and a second. Any further discussion? Okay. All those in favor?
Aye.
Aye.
Okay, it's unanimous. Thank you. Motion carries. Thank you very much, David.
Thank you, Member Von Paris, Member Ardinger, Member Carroll. Good to see everyone.
Good to see you, and thanks for the good work you do.
Thank you, Member Von Paris. Appreciate that.
Okay, we will move on to item number 3, and it's the software maintenance contract. Charles Markakis will be presented. Good morning, Charles.
Good morning. So the maintenance renewal is for a 3-year contract for Rubric. That's what we use for our data center backup software and recovery system. Also backs up all of our file shares. This software has been used for the past 3 years. Has been very successful. Provides a very intricate level of indexing on our backups that allows us to extend the protection to ransomware protection as well. So we actually have the ability to detect and stop any potential ransomware attacks. That's one of the reasons why we chose it 3 years ago. So this gives us another 3 years of software and maintenance. Also allows us to continue expanding the software. We're looking at actually integrating it more with our disaster recovery plans as well. There's some new features that are being released for it, but it is a all-in-one package that provides a very robust set of tools that we'll be using for our data center recovery and backup systems.
Okay. Are there any questions from any of the members?
Member Carroll has a question. Does this software tie into any other security measures that the state currently deploys, or is this a standalone situation that protects what we do here at the MDTA?
So it provides for encrypted backups as well. So all the backups that we do take are encrypted in the event that they fall in the wrong hands. We also, as part of procuring, as part of the procurement process, we actually had to take it through an evaluation step through State Do It to let them know what it was that we were interested in procuring. And they did not have anything at the state level that was comparable as part of that Do It intake process that they just recently started doing. So I just from my own perception, it looked like they actually were interested in Rubric, which was interesting. And it was actually good on our part because I think Rubric is gaining a lot of ground in state government just because of the capabilities of the software. So that was very that definitely was a good thing that it is getting a little bit more publicity and a lot. The more agencies that use it, I think the better that the product is going to continue to get. That not that it isn't already, but it's definitely been very successful for the past 3 years.
Thank you for that.
Sure.
Thank you, Member Carroll. Any other questions? Okay, is there a motion to, let me say that I'm a little slow this morning. I was struggling with the technology, so a little rough around the edges here. Is there a motion to advance this item to the full board for consideration?
So moved, Member Carroll.
Member
Carroll?
Artinger, I'll second.
Thank you, Member Artinger. Any further discussion? Okay, all those in favor?
Aye.
Aye.
There's no one opposed. The motion carries unanimously. Thank you. And Charles, thank you for your presentation and the work you do for the DTA.
Thank you.
Okay, we will move on to agenda item number 4, and that's the last approval item on the agenda today. And we will discuss the presentation by Robert will be about HVAC maintenance and repairs contract, MDTA facilities contract.
Good morning, members. Good morning. My name is Robert Harrison. I'm the contract manager. This is for MD 3145 and MD 3155. These are HVAC repair and replacement contracts. The original bid was under 3145, which allowed bidders to bid on either Region 1, which was the central and northern region, or Region 2, which was the southern region. We were able to do up to 2 selections. Region 1, which is northern and central, it was awarded to Denver Elliott, and Region 2, which was the southern region, was awarded to Easy Electrical Contractors. This is a total of 5 years with a 3-year base and a 2-year option. Both vendors have been used in the past over the last 5 years. Any questions?
Any questions from the members? Okay. All right. Is there a motion to advance this item to the full board for consideration?
This is Member Artinger, also move.
Thank you, Member Artinger. Is there a second?
Member Carroll seconds.
Thank you, Member Carroll. Okay, we have a motion and a second. Is there any further discussion? Okay. All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you very much. And thank you also for Robert for your presentation.
Thank you, members.
Thank you. Okay, we will move on to agenda item number 5, an update on the investment committee report. Alan, Carmen, and Clayton will be here. Good morning.
Hi, good morning.
How are you,
Thank
Alan?
Great. How are you today?
Good.
I'll start
Good
it
morning.
off and turn it over to Clayton, and we're going to share these slides. The agenda slide is the second page. This is our normal quarterly update on strategy and total return performance for the portfolio and all of the accounts. The key points that we'll raise are that the portfolio is diversified and it remains in compliance with the investment policy and trust agreement. We believe that the long-term strategies should remain consistent despite the short-term return volatility associated with the rising interest rate environment. The multi-year returns should align with the financial forecast and approximate the starting rolling yields in the portfolio. And we'll touch on all those points in a little more depth in these next few slides. I'll start it off on the market update. is that I think everyone's aware that the Fed's fairly active. We're in a high inflation environment, which we haven't seen in decades. The Fed has hiked twice now recently. The first hike was 25 basis points, and then this more recent hike has been 50 basis points. They're communicating an expectation to continue hiking at least throughout this year. Fed funds futures market is projecting a Fed funds rate around 2.75 by February of next year. So if we have hikes at every meeting, the next 6 meetings, that's where Fed funds would end up. You can see on the chart that rates have risen more than 200 basis points for most of the curve. There's been more movement on the front end of the curve, but even long rates have risen significantly. Our portfolios, as you'll see on the next few slides, the match funded portion of our monies are very short term. They're inside of a year, and it's really just our general account and M&O reserve. Those are our longer term reserves where there's a lot of mark to market return volatility in those portfolios. So the other thing that the Fed is in the midst of doing is shrinking the size of its balance sheet. So it bought a lot of securities during the pandemic and really grew the balance sheet to try to drive rates down. And now it's begun to unwind that. So it's letting securities mature and roll off the portfolio, or is selling actively. So that pace of that unwind is expected to grow. So that should add supply in the bond market, which would in theory push rates up further. The table at the bottom just highlights that GDP is strong, the unemployment rate's very low, and inflation is quite high. The headline CPI numbers are 8%, and the Fed's more focused on core numbers excluding energy and food. But even that is quite a bit above the Fed's sort of 2% longer term objective. Before flipping to the next slide, Clayton, did I miss anything that you wanted to comment on?
I think one, if you meant to share the slides, I'm not seeing that, but we are on slide 3. And I did want to comment on the fact that, despite the difficulties in the markets, this is a positive story for the economy. Unemployment prior to the crisis, the pandemic in February 20 was 3.5%. It went as high as 14.7% in April of 20, and it's now back down to 3.6%. And nominal GDP is very high. And also, what's changed really is the CPI, given all of the stimulus that Alan has been speaking to. Thank you.
Yeah, Clayton, I'll turn it over to you for slide 4 then.
So Alan also mentioned or highlighted in his initial comments the fact that the portfolios are very diversified. And you can see that with the pie chart down in the bottom left, bottom right of the slide. We have exposure to various sectors in the fixed income markets, the biggest being the agency, and then second being the treasury areas of the markets. Typically, we can be higher or have high exposure to other parts of these fixed income markets, but we're always keen to relative value situations, and absent those, remain fairly conservatively positioned at present. On slide 5, again, this is speaking to the maturity of the overall portfolio, the agency portfolio totaling $810 million. As you may note, about 56% of these assets are in very short-term, 0 to 1 year maturity buckets, and so we use these cash for things such as debt service, operating expenditures, and also capital expenditures. I did want to say also that I hope you've noticed the changes to the slides. We're trying to refine these and make these better and more user-friendly. If you do have any comments, by all means, let us know, and we'll be happy to make sure we consider and improve these. Moving on to slide 6, we see the general portfolio maturity distribution. The general portfolio totals $302 million at the end of the quarter. And you can see here that we have almost a laddered approach. I would call it a refined ladder approach, where we're trying to match the duration of the index. And so the maturity and the duration are not exactly the same, but the duration does get us to almost spot on the index. Moving on to slide 7, we see the M&O portfolio. Again, this is a maturity distribution chart. We think in terms of duration internally here as we manage the portfolios, but this is relevant, and we do have guidelines that we adhere to related to maturity. You may remember that we began a transition to a longer duration strategy for this $51 million in assets in November 20 and completed that transition November of last year. Moving on to slide 8, Alan also highlighted the fact that we are in compliance with all of the guidelines for the portfolio. You'll see guidelines as they relate to maturity for at the top there in account types, bond service, unrestricted general, and unrestricted M&O. Again, it's important to note that we are in compliance with this guideline. And as I mentioned a bit earlier, the M&O transition, which was completed in November 21, has a longer maturity opportunity set. And so you'll see that or note that the longest maturity in that portfolio is 13.4 years. Are there any questions? No? Okay. Alan, would you like to handle slide 10?
Yes, thank you. Slide 10 shows the strategy for our two unrestricted cash reserves, as well as the strategies for the capital and the operating accounts. Those are what we consider to be match funding. So in capital and operating, that was the bulk of the portfolio, and that's shorter term, and that's essentially matching the investment maturities to projected spending. And with the capital program, a lot of those funds will be spent within 12 months. Operating funds are typically flowing in and out of our working capital account. And also in that category, we include bond service accounts. The agency pays debt twice a year, so those longest maturities are inside of 1 year. For the general account, we've had the same strategy for many years. We're benchmarking against a blended index of 1 to 5 year agency securities. The M&O reserve is about 14% of our unrestricted cash, so it's the smaller portion. We have accepted a longer duration strategy for that portfolio, and that's essentially staggered maturities out to 15 years when we use a zero coupon index that's 1 to 13 years. And we essentially chose an index that had a similar duration to our chosen strategy. And the key is, and this is something that we talked about back in 2015 and in recent quarters, is that the board made a decision with these indices to accept some shorter term volatility of returns, mark-to-market volatility, in exchange for higher average annual returns. So the longer your bond portfolio is, the more sensitive it is to rate changes. But over the long term, those portfolios tend to essentially earn what the prevailing yields were when you bought those securities. And we'll get into that a little bit more in the next slide. On slide 11, there's the top chart shows a graph of the yields for the longer term indice for the M&O reserve and the shorter index for the general account. And you can see that generally the yields for the longer index are significantly above the shorter term index. So you're getting some compensation for that greater volatility of returns. And if you look at the lower bar chart, you can see that, you know, at times those returns are negative. Anything below zero is negative. You can see that the 1 to 5 year index shows less volatility relative to that 1 to 13 year index. You can see the 1 to 13 has very high positive returns at times and negative returns as well. The less volatile 1 to 5 year index tends to say more positive, but generate lower returns. A few points on the right are that 350 million is a stable balance for the agency. It's part of the debt policy. It's a contingency reserve of funds that we don't anticipate tapping or using. It helps us to maintain access to the credit markets by having a liquidity position, but it's also essentially financed cash. So we're trying to maximize our long-term return and accept some shorter-term price volatility. And if you'll recall, the board had approved a strategy change just prior to the beginning of the pandemic to lengthen the duration of the M&O reserve because there was more renewed focus, I think, on how long-term these funds are. We delayed that transition because interest rates quickly fell to all-time lows and we didn't want to extend at that time. And then we slowly extended duration, you know, in recent months, and that was completed back in October of 21. The next slide, 12.
Ellen, can we pause here for a second?
Sure.
And okay, so one of the things that we talk about internally is the strategies. Should we stay with the strategy? Is there any adjustments that we should be making? And, you know, without a doubt, these markets right now, we're in the challenging times of the markets. You know, just if we were a little more than a year ago, you know, we were in very, very good times of the market. You'll see that in the next slide. But wanted to share with you slide 11 and 12 to just to reflect our thought process of, you know, with these difficult markets that we're in right now, you know, should there be any adjustments? And our recommendation to you, as Alan started off, is that we should be staying the course. We should not make any adjustments with our investment strategies. And you know, what we're trying to demonstrate here is that for the M&O, you know, greater risk was taken from the volatility in order to have that longer, the long-term better return compared to the general. And Alan has stressed a couple times that M&O is 14% of our $350 million. So part of the volatility is the ability to manage that volatility. And that's what we mean by the $350 million. It's constant. It doesn't really matter what's happening in the markets. We have to be able to sustain that. And so the thought process is we can manage the any volatility that occurs for the smaller piece of the 350 million, but let's start there and, you know, kind of work our way through, make sure that that's manageable, and then at some point in time in the future have a conversation as to whether or not any changes should be made for the general fund. And so as when the next slide, when Alan talks about it, you know, we recognize the challenging markets we're in right now, but the one of the member Von Paris asked me recently, you know, we were talking about our mindset when we decided the board, you know, staff recommended, the board approved extending the duration for the M&O. And our thought process was long term. This $350 million, it's money we have never in our history touched, nor do we have any intentions in the future of touching it. It's a true reserve. And for that reason, you know, taking a long-term look was better for the MDTA as opposed to short-term year-to-year look more associated with trading.
Rodinger has a question.
Thank you. Thank you, Alan, Clayton, and Deb, for this discussion. And Deb, I think you sort of answered my question, because I was thinking along those lines. We hear talks of a possible recession, and especially looking at year 2023. And so would there come a point where you would rethink those long-term strategies, or has that basically, even should we go down that road, you feel comfortable with our current strategy?
We're comfortable with our current strategy. And Alan, if we let Alan for a second start to talk about slide 12 and what we see there. And then if it's okay, Member Oringer, let me come back to your question, because it'll help further explain why we believe we're in the right strategy.
Yeah, a few points to raise is that, historically, when rates rise, you often get a period of, negative returns. And that, typically is a year. Sometimes it can stretch to 2 to 3 years, depending on how long your portfolios are. But it's important to understand that the portfolio essentially is resetting. The prices are falling, but also the yields are rising. So to change strategy, what you've often seen after periods of rate rises is that you get really high mark-to-market returns. Not only have the accruals risen on the portfolio because all your bonds have reset to higher yields, but it's possible you run into recession and then interest rates fall again. And so this was sort of part of the rationale for having a longer term and stable approach, is that we're not trying to time the market or guess what's next. I would highlight, I saw like oil price dropped sharply yesterday or the day before, and it was because China had shut down, part of their economy because of COVID. Again, these are the types of things that are very difficult for anybody to predict, which is really the future. And for the Fed's perspective, the Fed's anticipating this Fed funds rate at like 275. If you asked the Fed or looked at their predictions just 6 months ago or 12 months ago, it was nothing like that. They were all about transitory inflation, and the Fed minutes are indicating that it's all data dependent. So the hikes have already, driven mortgage rates up. You're seeing some decline in home transactions. So there's so much uncertainty, and we recognize that we can't predict the future. So if we kind of whipsaw the portfolio by lengthening and shortening, our recognition is that in the past we've remained short for very long periods of time and sort of anticipated rates were going to be rising after the financial crisis. And when that didn't happen, there was a recognition that you were foregoing a lot of return in the portfolio. So when you look at this slide, you can see that demonstrated is that the yield is this orange line, and you can see back in 2000 when rates fell, the blue bar represents the income or the coupon component of the return, and the green is the mark to market. And so you can see in the falling rate environment that mark to market really added to the returns. And then you can see in 2003 to 2005 time period and 6, when interest rates were rising, the mark to market was subtracting from your return. And so you can see kind of that cycle where rates rise, rates fall, and the mark to market really adds or subtracts from the return. And if you look at the post financial crisis, look at 2007 and 8, what happened was that rates fell and then they really stayed low. So if you had a short-term portfolio in that time and you were fearful of rising rates, you were basically missing out on sort of higher returns during that time period. And then if you recall, this is something that Clayton and I presented in 2019 and 2020, was that interest rates were very low during that time period, but they fell further because of fears in the economy and COVID. So the returns in the portfolio were over 4.5%, but prevailing yields were less than 1%. So that 1% sort of our longer term expectation. That's really where the securities are that we're buying at that time. They weren't at 4.5%. So I think, if you were back in 2018 and you were fearful of rising rates, you would have missed out on 2 straight years of 4.5% returns. And, right now it might seem like, it certainly seems likely that rates are going to continue to rise. What we don't know is what will happen after that. Does the economy slow? Do we run into recession? Do rates come back down? Or do they merely stabilize at sort of a higher level?
So the point with, Alan, will you mute? Thank you. So the point with these two slides is when on slide 12, when you're looking at the yellow dot with yellow and black dot, they are the total return for when we're looking at things from an individual year perspective. And, so as Alan has indicated that our return, I think about it like as an average, and 19 and 20 were really good years, and we have lots of really good years. And so this is an overall cycle that we're going through, which brings us back to the former slide on 11, where we have data and history that shows the acceptability of this volatility on an annual basis, in the long run produces higher yields. And that's our reason for recommending that with the M&O, we stay with our current benchmark. And because it is 14% of our portfolio, and it's not as if the general account isn't seeing volatility, it's just not seeing as much of it. But considering the percentage that is with the $300 million, we feel like right now is the time to stay there. At some point in time, the thing that would drive us to recommend a change in the general account is if we could be in a place to be comfortable to say we could withstand this type of volatility on the general account as well. Because, we always talk and, everybody loves the good times, but you've got to be able to weather through times like this as well. And that's the real basis behind recommending that we stay with the benchmarks that we have. And, we wanted to show on slide 12, just to see that relationship that exists consistently when rates rise, mark to market, you have losses. When rates fall, you have gains. So let's, if we want to stop there for a second, just about strategy, if there's any questions, and then Alan and Clayton be happy to talk about our total return. What have we experienced with our returns based on these strategies? And Member Ardinger, does connecting it with slide 12, was I able to answer your question?
You did. Thank you.
Mm-hmm. Okay. So
I just want to comment too that I think it was an excellent question and very good discussion, very good to hear the perspectives, different perspectives on this. I think it's really important to have this kind of discussion. So thank you for that question, Member Ardinger, and also Alan and Deb for your comments.
Alan and Clayton, do you mind continuing?
All right. So on to slide 13. This shows the total return performance for just the general account portfolio, which is about $300 million. In our financial forecast, we model 1%, longer term return for the unrestricted cash, and that is tied to what prevailing interest rates were. We've talked a little bit about the concept that the portfolio over a longer period of time essentially earns what the prevailing yields were, particularly the starting yield. So if you think back to just really recently in August of last year, the yield on the index, the 1 to 5 year index, was only about 40 basis points. So 0.4%. It's now 2.72%. So that's how much the yield on that index has risen. Our portfolio is the same, as the index essentially. So the prices have declined and all the bonds have reset to significantly higher yields. The M&O reserve is similar. The yield on that index was about 1% in the portfolio back in August, and now it's 297. There's a concept called rolling yield convergence, and that's essentially that there's some certainty with which you can predict the returns of your portfolio despite the mark to market and despite movements up or down in interest rates. So if you look back about 5 years ago, the portfolio yield back to February of 2017 was around 1.6%. So if you look at the upper right corner, you'll see the returns over the last year. The portfolio's down 3.5% through the month of March. It's a little smoothed out when you look at 3 years. The return's about 1.17, and the 5-year return at average annual return is 1.4. And what's interesting is that 1.4 aligns with the starting essentially yield back 5 years ago. And I think that helps to demonstrate that we had 2 successive years of 4.5% returns. We had years prior to that were much below that. Then we've got this negative return. And then you can see over this 5-year time period that essentially the portfolio returned that kind of 1-ish% that we're anticipating. And that's also what, we're kind of conservatively modeling in the financial forecast. So when Deb, highlights that we can tolerate the volatility and accept, higher average annual returns, if we were sitting in cash during those 5-year periods, we would have been earning very close to, 0% returns. Money market fund yields were, around 1/100% for, much of that time. So that's sort of the volatility return trade-off demonstrated. If there are any questions on this slide, if not, I'll move on to the next slide. So the next slide is a slightly more complicated story. It's similar. The M&O reserve, as you know, we changed strategies to lengthen the duration of that portfolio. And so I think, the obvious question might be, well, if you're looking at the former index and the current index, and we were in this lengthening period, why is our return not somewhere between those two portfolios? And the answer to that is really that, we missed out on some of the higher returns for that index while we were short. And then when we went to extend the portfolio, we were extending in a rising rate environment. So we took the negative returns and we missed out on some of the higher returns that would have balanced that out. So you can see the former index's return was the same as a general account. The current index return and the portfolio's return of -6% over the trailing 12 months. And then what that return's been over the 3 and 5 year periods, about 0.81. And to back to 2015 and some recent more in-depth discussions we had with the board and the finance committee, is that we looked at more than 40 years of historical return data and quantified, what the negative years looked like and the positive years and the return differential. And what we recognized on the $350 million is that, the differences between the shorter and long-term indices would add, tens of millions of dollars in multi-year returns over 20-year periods to the portfolio. And so that's really what we're focused in on is those multi-year returns.
So with in conclusion, the M&O, it's aligning closer to the portfolio. You'll see more of that each month. We talk about a minute ago staying the course, The M&O is like an example. We were transitioning into a new benchmark, but think about those folks that were in it and started bouncing around. They would have lost that growth opportunity, and that's we weren't adjusted and moved over into this new benchmark yet, and that's affecting our returns. So our recommendation is to continue with the current strategies. And, as Clayton mentioned, we've revised the slides a little bit more. Happy to receive any feedback as, we continue to adjust them and try to drill down to the most critical points when talking about our portfolio. So Member Von Paris would be looking for Finance Committee's concurrence on maintaining the strategies that we currently have.
Well, I guess it's, we have this listed as an update, but I guess there's.
This one's always challenging. It's honestly, it's a little bit of both, right? That on a quarterly basis, we take this item to the full board for their approval to continue with the strategy. But at the same time, we're providing a much more comprehensive update to the Finance Committee. So it's primarily an update, but we do seek your concurrence because of taking this to the full board for approval later on this month.
Member Von Paris, excuse me, this is Natalie for the record. I know Deb's asking for your concurrence. I just wanted to make you aware. Member Carol was having technical difficulties and had to drop off the meeting and will not be back on the meeting. So we do not have a quorum of the board for the rest of the meeting.
Okay. I guess items that we will, well, there's nothing absent of this discussion we're having right now. There's everything else is an update, but certainly my comments on this were, and thank you for that, Natalie. Thanks for the update on Member Carroll. But as far as I think this was good discussion, I have no intention to stand in the way of this. So I think that it should, the next move on this should be with the board. And I have no objection to what's going on. So that's, I guess, Member Ardinger, do you have any comments?
No, I would agree with what you just said, that when it's presented to the full board, thank you. I think everybody did a great job explaining strategy-wise. No question, we're in a very difficult time with the market and volatility, and I feel comfortable with this discussion and how we're going forward with the strategy.
As do I. And I also echo what's been said here. It is a challenging time. We are in compliance with our policy and also with our trust agreement. And I think that the work that has been done here by the team is pretty remarkable. And I think we have a talented team. I know it's a lot of effort and it's a lot of time, and some of you, or all of you, spend way beyond the call of duty. So it's very much appreciated, the effort that you put forth here. And also, as a side note, I like the changes to the slides that Clayton had mentioned. They are more seem to be more user friendly to me. So I appreciate that touch there too. So I think you got your answer, Deb.
Yeah, thank you. Yes, we agree. I think we have a very high quality portfolio. All the credit goes to Alan and Clayton. yourselves, senior management, it's one thing to provide direction. It's another thing to execute it and grab the relative value that they do on a consistent value. So the credit goes to them. In some respects, we have a little bit of the easier job. This is something they actively work on every single day. So thank you.
Good. So you're comfortable with our response to your question?
Yes.
Good. Okay, good. That's important. All righty. Thank you all again. And then we will move on to the next agenda item number 6. And that would be the third quarter budget comparison. Jeffrey Brown is going to present. Good morning, Jeffrey.
Good morning to all. For the record, my name is Jeffrey Brown, the Budget Director for the MDTA, and I'm here to provide an update for the third quarter year-to-date budget performance for full year 2022. As of the end of the third quarter, we had spent 52% of the budget compared to a target of 73%. All objects were below the targeted spending levels except for Object 13, and provide detail below. The key drivers of this performance through the third quarter are essentially personnel vacancies, which drive most of the underspend budget. There's certain seasonality and timing of invoices which accounts for some of it. And there are some ongoing COVID effects, especially to the supply chain and especially to some EasyPass service center costs, which we will get into later. Moving on to some more detail, Object 1 is below budget at a 65% spend. As just mentioned, it's the ongoing vacancies account for most of this performance going through the third quarter and going forward. Communications, Object 3 is at 25% spent. And the main driver of this is the one invoice, essentially a state paid telecommunications bill of $1.7 million, which has not occurred yet. So that's really driving most of the underage at this point. Some additional underspend is due to vacancies, less telecommunications costs. Moving on to Object 4, travel is below budget at a 24% spend. This is ongoing COVID-19 impacts. Things like increased teleworking and telelearning, and some postponement of in-person conferences drive this underspend. Object 6 is fuel and utilities. It's at a 56% spend. The biggest driver of this is electricity, and that's due to some LED replacements and the shutdown of the toll booth removals. That's driving some of the underspend in the electricity costs. Moving on to Object 7, which is motor vehicle operations and maintenance. This is really supply chain delays. Vehicle orders are not coming in as expected. So we expect that this will result in some rollover into full year 2023. Contractual services, Object 8, quite a few objects in here for advertising, engineering, equipment repairs and maintenance, and building repairs and maintenance. They're below budget and really driven by timing and seasonality. Many of the higher expenses occurred towards the end of the year. However, there is expected some savings potentially in 812, which is building repairs and maintenance. This is due to the virtual scale maintenance contract, which at least at this point appears is coming under budget, but we are going under additional review with that. Moving on to janitorial services, 813, it's at a 52% spend. That's driven by the lack of access to the Keybridge campus. That reduced the janitorial expenses for the year. Education training, 819, and management studies, 821, are both tracking below budget. Education training is at a 28% spend, while management studies is at a 42% spend. We do expect this to come tracking back somewhat to budget, but the impact again of COVID-19 on education and training may have some savings in that area. And additionally, there are reduced requests for management studies this year, so there may be some potential savings there as well. Security services, 823, we do expect savings here. There was a budgeted security service contract which is coming under, and we estimate that'll be a $300,000 pickup in that object. Fiscal services, or the EasyPass retail fees, 829, is currently below budget with a 45% spend, but this is trending back towards budget. This is due to the fact that we are processing the backlog on NOTDs. So we do expect this to continue to increase as we go through that, and it's coming back towards budget. The objects 841 through 869 are primarily IT objects, and these are tracking to budget. Any of the changes have been timing. Some of the big invoices come in at certain times, but at this point, they're all coming in as we expect, and we expect these to be on budget. The big cost areas, Easy Pass Service Center costs 873. It's currently at an 8% spend, but we do expect this to be over budget. And this is pending a modification to the TransCore contract to hire additional customer services representatives and the costs associated with all electronic tolling. Part of the reason we're hiring those customer service reps is to reduce the call center wait times. Moving on to supplies and materials, Object 9, overall is at a 65% spend. You can see roadway maintenance materials 0905, salt 0906, and uniforms 09112 are all below budget. The big driver on this are timing and seasonality has been mentioned for these, but especially with uniforms at a 46% spend, there's been supply chain issues, so they haven't come in as expected. So that's driving some of the underage in those objects. In addition, we're through the winter season, so we do expect some savings in the salt object 0906. The big hit in Object 9 is Easy Pass transponders. It's currently on budget at a 74% spend, but we do expect this to trend above budget. There is demand as we've gone to all electronic tolling, so there is increased demand for transponders. In addition, there is a significant number of 10-year-old transponders out there that will need replacement, so we do expect this to trend above budget. Object 10 is at a 41% spend, mostly driven by the Nice Middleton Bridge administration building delay. We do expect these funds may need to be rolled over into next year. Additional equipment, Object 11, is at a 22% spend. This is similar to the vehicles purchases. We've had supply chain issues and delays associated with this. So we do expect this may be underspent, but that will be rolled over into next year. Finally, Object 13, the only object is over at a 93% spend, and that's primarily due to an excess property liability cost came in. That was showed an increase of over 30%, and that's really driving this increase for this object. That concludes my presentation. I'd be happy to take any questions at this time.
I looked through everything and given a pretty thorough explanation. I may have some questions that I might come back with, later, but not at this point. Member Artinger, do you have any questions?
This is more a question for my own clarification. So when you are looking at percentage of overspend, and I always look at percentages. That's the category I go to. I guess you're looking at the total object and not the breakdown, because then I see some in here that, of course, bad debt is like, whoa, what happened there? But I mean, when I break it down individually, but I'm assuming your focus is more on the category as a whole. And have you reached an overspend on that? Am I understanding that correctly?
Yeah, I mean, it depends on, what specific object, but typically I'll look at, the total overspend in an object, and then specifically within those objects, the sub-objects, usually will focus on those specifically and what the percentage may be overspent as well. But yeah, it just depends where you're looking at. And we don't go through obviously every sub-object because like you said, you'll see some major changes and variances, but one of the things we try to move along in looking at this detail is we want the budget to be at least 500,000 as well. So we're not as focused on, if it's a 100,000 budget, but it's got a big increase, we keep track of it, but we don't necessarily will report out unless there's a specific question.
Thank you. That helps me with my clarification.
Okay. Thank you very much, Jeffrey, for the update.
Thank you.
Thank you. We will move on to agenda item number 7, third quarter budget comparison. Jeannie Marriott will present.
Good morning. Good
Hi.
morning.
Good morning, Jeannie. How are you?
I'm good. How are you?
Good.
I'm here to update the Finance Committee on the status of actual fiscal year 22 spending against the fiscal year 22 capital budget in the fiscal year 22 through 27 draft CTP. And this information will be presented to the full board on May 19th. As of March 31st, 51% of the fiscal year 22 budget was spent as compared to the targeted spending level of 75%. The total budget for fiscal year 22 is $602.9 million, and the actual spending through the third quarter was $307.4 million. 28 of the 95 projects budgeted in fiscal year 22 were within the acceptable spending limits of 50 to 100%, which is plus or minus 25% of the 75% target. Due to normal lags in invoicing, generally 2 months, a plus or minus 25% threshold was determined to be reasonable. Actual spending through the third quarter for 8 projects budgeted for more than $10 million each in fiscal year 22 was $210.9 million. And if you will turn to attachment A, we see the 8 projects listed that had fiscal year 22 capital budgets over 10 million each. And they range from $227.7 million for the replacement of the Nice Middleton Bridge to $11.8 million for the Eccleston mitigation portion of the ETL northbound extension. So the combined rate for these 8 projects is 51%. The spend rate is 51%. And I'd be happy to answer any questions you may have.
Barninger, any questions? No. Okay. Jeannie, I'm okay as well. Thank you very much.
Great. Thank you.
Okay. We'll move on to the last item on the agenda, item number 8, quarterly update on traffic and revenue. Deb Sharpless and Cheryl.
Thank you. I'm going to start off the discussion today and present to you a traffic and revenue update consistent with how we've been doing it at the board meeting, a handful of months, this fiscal year. And then when I'm going to turn it over to Cheryl, and Cheryl's going to talk about a quarterly report from our independent traffic and revenue consultants. We work with them on a regular basis. Previously, we would provide you with quarterly updates from them. So we are restarting that process, and she'll talk about that in just a minute. So starting off on the first page of your summary memo, let's talk about key takeaways first. And the first one is that we're expecting our revenue to be under the forecast, so under performance for the fiscal year as a whole. Now, that underperformance will not impact our ability to maintain our financial coverage. We will be significantly over that. I'll explain why in just a few minutes. The underperformance, we have some timing differences. We have a little bit of shifting that we expect from a slowdown where some transactions, we had a fix that was in a system. It was just slowing things down a little bit too much. And then the other thing is that contributors that were like overtaking the things that were pulling down our performance throughout the first half of the year, they're no longer strong enough to offset those. And that's why you see us where today we exceed the forecast. This is as of March 31st. But as we get further into the fiscal year, that number will become negative. So let me explain this in some greater detail, starting with the summary, the snapshot table that you see. where the first half of it talks about Easy Pass and where are we, in the second half includes video, administrative, and pay by plate, and then we have the total column. It's consistent with other presentations. The adjusted difference is our forecast plus actual revenue. Actual revenue means cash in hand. If you recall, that's how our trust agreement, our coverage are set up, is on a cash basis. And therefore, the reason why we track our performance on a cash basis. So from a cash perspective, we're $8 million below our forecast. Then finance adjusts for what we're calling timing differences. These are transactions that from a TNR perspective, we expected to be received, processed and received as of March 31st, but for which we still reasonably expect they will be received by the end of the year. And so that adjusted number of revenue is $1.4 million ahead of the forecast. So now if I move down to page 2, I'm going to talk about in the section called changes in unadjusted and adjusted differences compared to the forecast. And what you see in this table is what did that total column from the table above look like at January 31st. And at that time, our adjusted difference, we were nearly $12 million ahead of the forecast. Now, as of March, we're 1.4 million. And so why did we have this $10.4 million shift? Well, first, it's understanding what's the key contributors to the change. And one of them is this overstatement of our financial forecast that we talked about previously. If you recall, back in January, we recognized, along with our TNR consultants, that there were some backlog revenue that was accidentally counted twice in our forecast. So every month, another piece of that error gets added into our forecast. And so if we go from January to March, that equated to $6.7 million. Next is that our average video toll rate is lower than forecast. That from January to March totaled $4 million. Now, previously, that was a plus. Previously, video tolls, the average video toll rate was higher than forecast. And I'll explain the reason for the change in just a moment. Also, our pay by plate is lower than what was forecasted. Now, these factors that have pulled down our performance, there are some that offset them. And the first two are the average Easy Pass rate is higher than what was forecasted, as well as our video toll collection rate is higher than forecasted. Together, they total 4.3 million. Also, civil penalties from January, the month of January, and partial February, up to the point of the customer assistance plan being approved by the board members, our civil penalty collections was higher than forecasted, which was 2.1 million. Now, the other adjustment is in January, we had $3.4 million in a timing difference category. It was part of the 29.8. We have not included that in March, just with some, it's that confidence that that will absolutely materialize by June 30th isn't the same level that we had in January. And in order to be conservative, we removed that from our March numbers. Now, through January, it was both the Easy Pass and the video toll rates and the video toll collection rate and the civil penalties. All of those were higher than forecast, and they offset what was pulling down. As I just mentioned, Easy Pass continues to overachieve the forecast. However, starting in mid-February, the average video toll rate has decreased significantly. And that's because of the NOTDs that we have been mailing. In the beginning, we were mailing more current NOTDs. Now, the mailings of the NOTDs during this time period, they were overweighted by older NOTDs when we had reduced the video toll rate temporarily to the cash rate. And the forecast assumed a FIFO basis. So when we were overachieving, the video toll rate was assumed to be lower and ramped up over time. And we've done a little bit of the reverse from how it was forecasted. So in the trends that I'm talking about, we also have civil penalties where that had been some revenue that was being received. Well, now, there will be no more civil penalty because of the customer assistance plan. So these factors, what that means to us is we expect this trend to continue where we'll be under the forecast. And some of this will be a shift into 23. So that's the reason why it kind of transitions us from where we were in January to where we are in March. But then when we look at the financial forecast, and because of how much revenue has been processed, we had that shift from last year into this year, our revenue could decrease by nearly $300 million before we would violate our 2 times coverage. So this underperformance that we're talking about from the forecast perspective, just wanted the members to understand that there's no risk at all of that impacting the ability to maintain its financial standards. And as a quick update with the customer assistance plan, that runs from February 24th through November 30th. As of April 30th, there's been $17.4 million in civil penalties that have been waived, and that waiver has been given to roughly 108,000 customers who have paid $10 million in previously unpaid video tolls. So now in the following slides, I'm sorry, I didn't mean to say slides, in following pages, page 3, we talk about the analysis, and the analysis can be found on attachments B and C. I don't plan on going into any detail with those. The information that was presented is a summary of what can be found on attachment B and C. I'm sorry, A and B, and then C and D is presenting our actual revenue. So this is cash in hand, where we sort it by facility and then by payment method. So if there aren't any questions, I'll stop here. But again, happy to answer any questions that you may have.
Deb, I have a quick question here on the, you mentioned the overstatement, or was the counting of revenue by the consultants. Is that what you said?
Yes. Yeah. The TNR forecast. Yes. It some backlog transactions. I mean, this is the first time we've ever. Okay. This is the first time I'm ever aware of an error from our traffic and revenue consultants. For they've been a long time. Sure,
but I guess we've identified what was the root of that error, the problem there, and corrective action has been taken, I guess, too.
Right. So there's no corrective actions on our part, and because it affected fiscal year 22, the next TNR forecast, 23 beyond, will not be impacted by this error. Essentially what happened is some revenue that was associated with the backlog, it was accidentally counted in both the backlog and current EasyPass transactions. So that's why there's no future impact on us.
Thank you.
The member Ardinger, I did have a question. I just want to understand. So we I'm trying to get down to what do we think now is the actual difference between projected revenue, and I'm talking dollar wise, because with the offsets, what would that number be?
You mean as of June 30th?
Yes.
That's a very difficult number to project right now, because we have a number of transactions that we continue to work with non-Maryland Easy Pass agencies, the interagency group. It's dependent upon the processing of transactions there. It's also dependent upon some processing and mailing of NOTDs. So if I expect at this moment, it will be in excess of $25 million, but that number really could change. It could go up, it could go down. There's just a lot of factors that could move right now, that we need to have panned out. And in April, for example, in this month or last month, the number of days that we had been processed was significantly less than former months. Now, as we're into May, it's coming back into normal. And what happened was there was a preventative control that was introduced into the software logic. Our system has, enormous amount of controls in it. Whenever possible, we try to have preventative controls in our process, whether we're talking about toll transactions or any other part of our organization. We had changed from a compensating control, which means that you're going to detect if something went wrong as opposed to prevent it. We tried to shift from a compensating control to a preventative control. And that shift slowed down the processing dramatically. And therefore, we've had to shift back to a compensating control. So the control structure is still there. What we know is we've got to go and we have to refine that preventative control more so that we can get to a preventative control, but without affecting performance. And so that's just one example of things that can affect where we end at year end. So if absolutely, if there was a number with great confidence that we could share, we would have included it.
So when you say, though, that you feel comfortable that this isn't going to affect the 2.0 debt requirement, you say that based on you feel that there's a range and we're not going to fall outside that range.
Yes, and the range is nearly $300 million. So, and honestly, I didn't look at it, but in my head, I'm sure we could not, pardon me, if we didn't collect, any money, we would probably still make our coverage. I didn't look at that, but for nearly a $300 million differential right now between 2 times coverage and where we'll be, it's theoretic. I can't even envision how it's possible for us to not make our financial standards.
Thank you.
Thank you, Deb.
Yeah. Yep. Now, one other just real quick point, I'll be very brief, is a few minutes ago, Jeffrey gave an update on the operating budget, and we talked about, significant under spending, personnel, wages, salaries, benefits, we're, I think if I net burden, our benefits and all, we're probably $40 million under in salaries as of right now. So there are, on the operating budget side, there's, good news there that offsets it. And that's one of the strengths of the authority, is that these levers, in order to maintain our coverage, we have many of them. when, to cover, any shortages.
Point. Okay, is there anything else, Deb, that you have to share, or anybody have any other comments?
No, I'd like to turn it over to Cheryl Lewis-Orr for just a moment so she can talk about the second half of this item, which is to refamiliarize you with our TNR consultant review.
Hi, Cheryl.
Hi. Good morning, Member Von Paris and Member Ardinger. The purpose of, for the record, my name is Cheryl Lewis-Orr, Director of Revenue, and the purpose of this agenda item is to provide a brief quarterly and year-to-date update from our traffic and revenue consultants, CDM Smith. They continue to track our traffic at the lane level and revenue collected on a cash basis. Some of their report is attached to this memo, and some of the key takeaways regarding year-to-date performance include our passenger car traffic levels are nearly back to pre-pandemic levels, and this can be seen on figure 1 on page 2 of CDM Smith's attached traffic and revenue performance report. And the same figure shows commercial vehicle traffic continues to perform well. And while our system-wide year-to-date transactions were below forecast, strong collections of notices of toll due, or NOTDs, yielded transactions that were above forecast in the third quarter of fiscal year 2022. Now, on page 2 of this memo is a chart, and this chart shows that for the fiscal year ended March 31st, 22, our system-wide transactions totaled 125.5 million transactions, which were 64.1 million above the same period last year. And revenue increased by $268 million compared to the same period last year. These increases were due to the ongoing recovery in the traffic from the pandemic and strong collections from the delayed NOTDs. Our actual transactions were below forecast by 8.2 million for the fiscal year ended March 31st, 2022, and revenue was below forecast by 8.1 million for that same period. And as mentioned above, although year-to-date transactions and revenue were below forecast, strong collections of delayed NOTDs yielded transactions and revenues that were above the forecast in third quarter. And you'll note on a combined level, our transactions exceeded forecast by 1.7 million for the third quarter and $201 million for the third quarter. So that is a high-level view of the traffic and revenue report from CDM Smith. I'll be happy to entertain any questions.
Member Archer, do you have any questions? I do not. Well, thank you very much, Cheryl.
You're welcome.
So Member Von Paris, that concludes the materials that we prepared for you for the Finance Committee.
Well, we appreciate that very much, and the excellent work that you do, both you and your team. So that pretty much gets us to the end of our agenda items. Of course, we don't have a quorum to adjourn, but I'm sure that we can reach out eventually to Member Carroll and have him sign off on this. But with what we have here today, is there a motion to adjourn?
I will so move. Member Ardinger.
Thank you, and I will too. All those in favor?
Aye.
Aye. Thank you all very